Okay, I'm back and I'm gonna spend a little bit of time going over some of the flashcards I wrote down for the Valuation book by Damodara, and then also probably go over some of the flashcards and read some of the chapters of the book itself. But I think right here, let's see, what if we study now? The adjusted present value approach for discounted cash flows valuation, I think, is a way that I haven't fully understand, or I don't fully understand exactly how it works, but from the perspective of the first introductory chapter of the book, which I think is just an introduction to valuation, the adjusted present value approach to a DCF model has to do with finding the present value of the debts in dollar amounts, and I think the present value of the equity, and doing something in between that. Oh, getting a call real quick. Let me get this. Yeah, 10 minutes is okay. Value of business, value of equity financing. With 100% equity financing, present value of expected tax benefits minus expected bankruptcy costs. In a more conventional approach, the effects of debt financing are captured at a discount rate, the cost of capital, but the adjusted present value approach tries to estimate the actual dollar value of the benefits. Okay, this one's kind of shaky. The excess returns valuation framework is another way of valuing a company. I think has to do with finding the present value of the cash flows in excess, whether it's below or above the predicted, I guess, the normal cash flows that you would expect to receive for some type of required rate of return or expected return. So I guess for discounted cash flows model, we're really discounting cash that has been predicted or forecasted to be received in the future. And let's say whatever price our asset is currently being set by the market, I guess we could say that that could be the actual present value of all of the expected cash flows for some rate of return that we think is the expected return. And then anything below or above in our forecast for those cash flows that would relate to a higher or lower present value, those are the excess cash flows. Cash flows that are above or below the required rate of return. Okay, so value capital investing from today plus present value of excess return cash flows from both existing and future. Alright, that could kind of be better, yeah. What is the capital asset pricing model used for? So the capital asset pricing model is used as a way to measure risk, and specifically risk geared towards just market risk. So usually under the capital asset pricing model, we define the returns of some type of asset as just the combination between the risk-free rate and then the exposure of that asset to, let's say, a market portfolio. And that's captured in the beta, which is used to multiply then the, excess return of the market portfolio. What is the basic intuition behind the arbitrage pricing model? How does it differ for CAPM? So both the arbitrage pricing model and the capital asset pricing model are ways to kind of measure this idea of risk, but it does it in different ways. So with the arbitrage pricing models, risk can be thought of as the exposure of an asset's returns to different factors, as opposed to the capital asset pricing model where the actual risk is kind of defined within the asset's beta, which is the exposure of the asset's return to the market portfolio return. So with the arbitrage pricing model, you're not relying on a single factor, which is just the exposure to the market, but whatever factors that you find in the data, whatever you want to define, your assets returns all have different exposures to those factors. You wanna go? The arbitrage pricing model.
Yeah, let's go.
Okay. Alright, I'll pause this for later then.
Hi, Pokey.
Okay. Goodbye.